Welcome guys to this Keep It Simple video. Now in this video we are going to be looking at the extras that can be added on to the money in, money out principle that we teach you in the Keep It Simple series. Now of course, if you don't know what I'm talking about in terms of the money in, money out principle taught, then head to Keep It Simple part 1 and watch through to part 5. It's just over an hour and you can watch it relatively quickly. This will mean a lot more to you when you watch it. If you try and skip that bulk of the content out, you will find holes in the principle. We are going to be talking about the things you can add on to the Keep It Simple series to add confluence, to add even more probability, to add lower time frame scenario setups, to add all of the stuff that you may want to personalize this strategy with. So in this +1 video, we're going to cover the principle and core concept having confluence behind the money coming back into the market. As money coming out is all good, but if the money continues to come out, the money coming in to follow that trend movement is always going to be hard to depict. So if you're not already, hit the subscribe button and hit that thumbs up button, and you can find all the relevant links down in the description below. But let's get on to the diagram section of this video, and we're going to walk you through the points that we are going to show you. So now we're down on the diagram section, and you can see on the chart here we have the Keep It Simple add-on. Now the reason we are showing you this stuff is because there is so much importance when it comes to relevance, keeping the overall trading system simple, keeping the relevance and principle of the money in and money out contained within something that is relatively usable, and it also stays non-complex. Now this is the principle behind the whole series, is to keep your crazy complex price action charts as relatively easy as possible. Now of course trading is not easy and we all know this, but if we can keep our analysis and our basis of our bias contained within a very simple, understandable principle, it's going to add more relevance to each trade that we take. With this diagram area, so we're going to walk you through each of them and explain them in an illustrated manner. As you guys know, I'm amazing at drawing. Pablo Picasso in the flesh. And then once we've done that, we're going to go down to a chart and we're going to show you the same principles on a chart. And we're going to obviously show you how you can begin to apply this. Referencing a couple of different points in price. We're not going to be doing a full breakdown of a pair from bias down to our setup, because that is what the live streams are for. And of course, if you haven't watched the live streams, head over to the YouTube channel here and you can of course watch some of the live streams back. No pressure if that's not your thing. You can learn everything that we're teaching you in those live streams from this series. That is the beauty of it. So let's start this off with liquidity. Remember, liquidity is at the core of the Keep It Simple series. So liquidity as a whole is going to be our starting point. Now, when it comes to liquidity, it's going to come in a couple of different forms, and I've explained this to everybody before on the live streams. Now, the reason why it's going to come in a few forms is because you're going to have your higher time frame, which is going to be whatever your biasing time frame is. So it's going to be highs and lows in terms of how is your biasing time frame giving you its relevance. Is there a high? Is there a low? Yes. Well, it's going to be the highs and lows in that time frame that's going to give you that relevance. So let's say your biasing time frame is up and there's a low in here. Maybe there's a low in here. You're going to use the liquidity of that to give reference to the Keep It Simple in and out money principle. That is going to be a uniformity across the basis of liquidity. Now, when I say it's going to be a uniformity, I mean it doesn't always have to be higher time frame. It doesn't always have to be biasing time frame. That's why I said it comes in many different forms, because it could be any of the relevant time frames as long as it's before your entry time frame. So as long as we have liquidity that either sits internally to the structure you're biasing, or it sits at the base or the high of the structure you're biasing, then we can begin to use that as a principle to confirm the money out and money in. The same basis is going to follow over from liquidity into orders. Now, the reason I say this is because liquidity itself is going to be found everywhere across multiple time frames, but it's all to do with where are the orders, right? Now, we know that the orders are going to be situated at the bases and the peaks of the money in and money out principle. Now, if we're looking for sells, we're of course going to find orders at the peak of this area, right? Now, we actually cover this in part 5 on an hourly time frame, and we set our orders at the place that the orders are found themselves, using the high in the case of sells as the stop area, and using the institutional order area as the point that we activate our sells, then looking to travel down in that trend direction, right? Referencing the money in, money out principle to locate orders as we showcase in part 5. Volume is going to then, of course, lead on, because without liquid and orders, there is no volume. So using volume as a indicator as to where you can look to follow and add principle to the money in, money out system is very good. The reason for this is because you may have, or we do have, and we know this, sections throughout the day where volume will spike and trade higher or lower within a certain time frame, right? Then you have your low and low volume of Asia, which is where we don't really trade. So if you see a money in, money out principle occurring at the peak volume, it gives a lot more confluence to the money coming back in to that and playing off of it than it does if you're trading it off of, let's say, a low volume of Asia. Again, very, very simple. Like I said, guys, this is not going to be any crazy groundbreaking stuff here, but it's keeping the core principles of the liquidity, money in, money out system at the forefront of your trading. It's not adding in 1,000,001 other things. So coming again off the back of volume, that is going to lead us directly into sessions. And again, why do we say this? Well, notice how we mentioned Asia down here. It's going to follow into this because we know that Asia holds liquidity. We know that highs and lows of, let's say, London can be used also as liquidity, and generally they will offer a mid to high time frame, high or low, which we probably will be referencing anyway. So these are the 4 points that you can use to add on to the Keep It Simple series. Very, very simple. We're not going to go too crazy on explaining them. It's pretty basic. We're going to go down now to the live chart, and we're going to show you each of these principles delivering a money in, money out scenario. So in this example, you can see that there is a clear biasing to the upside. If your bias time frame is telling you otherwise, you would of course have to reference. Because we explained this principle first, and as we said before, it is the core of the concept, you're going to see it a lot. And you can reference this and go and check out any point in pricing. You're going to see this. In this scenario, our biasing is up, and we can see that we have a collection of lows that are going to be represented as liquidity. Now, this is the 15-minute time frame. You can go to any time frame and see this happening. And if you watch my live streams, you'll know that I use my liquid lows as 15-minute, but you can reference the same time frame you enter on as the time frame you use these principles. Now, of course, it gives more confluence if you use a higher time frame to then trade a lower time frame, but it's up to you how you apply these points. So what we have here is we have several points of liquidity. And again, I expand on the external points of liquidity and the understanding of that in the live streams. Now, you can see that all of the points of liquidity are taken here, and the same time we're taking this liquidity, we have a clear money out, money in scenario given after taking the extreme point of liquidity. Again, giving you an entry of price right here to follow the biasing move to the upside. So it's very, very clear. Now, even while I'm showing you this, if you simply look to the left here, look at the same way we have, delete these, we have the same thing. We have a liquid low right there. We have a liquid low just there. We also have a low here, right? And they're all taken out by this move. And this move has a very clear money out, money in, price comes back into that region and continues higher. So the liquid is always going to be at the forefront of this principle, and as you know, if you haven't watched it already, the Keep It Simple series explains this and breaks it down into very easy and manageable points. So keep your points and add-ons as simple as the series. So as we mentioned, you can of course use orders, as we showed you in part 5, to give more confluence and have a relatively strong idea and understanding of where price action is most likely going to behave in a certain way. Now in this case, if you look at the money out, money in scenario, we know that the orders sit here and that the initial institute orders and retail stop losses are going to sit underneath the low. Now, we know most of retail don't follow this principle, and a lot of the time these areas are swept. But if you can add confluence to your point of orders, i.e. money in, money out, or vice versa, it is going to add a lot more confidence and principle to the setup that you're following. So when we zoom in here, you can see that we have contact with this area, and you have a clear money out, money in principle, and price travels bullish from here. Now, of course, there are always going to be points where this doesn't happen and price will just disrespect it and go straight through. But if you reference this whole range here and based off of what your bias is, it of course will change. You'll see that there is no other unmitigated points where we've had the money in, money out principle. This is the only point left, except for the extreme lows below. So this is a very clear example of the same principle that we discussed in the diagram section. In this example, you can see that we have a clear session high. We of course have the session low down here and then a low below that. We also have a previous high situated just above it, so it's adding liquidity to this. And then we have the money in and money out scenario occurring, giving you an area right here. Your stop loss will be situated above here, and you will then aim at targets accordingly. Now, as we stated in the earlier examples, the biasing is going to be independent to your time frame. So make sure if you're using these sessions as relevance and your add-ons, that you align them with your biasing. Of course, you don't want to try and sell if your bias is bullish and vice versa. So it's always going to be in line with what you're trying to follow. And just for context, you have, again, 2 more examples here of a high being swept of the Asia high and then having the money in an area to enter. Now, in this case, of course, you don't have a tap in, and we know this is the case with some scenarios. So don't expect every single trade you find to tap in, but you have a great example of it there. Then giving you just to the right over here, we have another clear money in, money out scenario while sweeping the liquid that sits at the base of, again, the Asia low. Keeping in mind the principle that we're showing you, it's very simple and it's based on your higher time frame bias. But notice how you could just use the sessions as a reference point if you like. So when it comes to following the principle of volume, there really is nothing to it when it comes to actually following it and using it in a way that is going to work. Now, really, all you need to be doing is focusing on the peaks of your volume, okay? The peaks of your volume, and focusing on what is it that these areas are doing, and is it something that we should be willing to follow. Now, if you notice right here, this peak is lining up perfectly with this money out and money in principle, ultimately giving you that big shift that you see right there, meaning that it has context behind it. You follow this principle up, you look at this move here, we have no money out here. Well, we do on the very far side, but we have a small amount of money in right here, and price action taps into there and goes bullish. Again, this is a very minor area, but notice how you can apply the volumetric understanding of orders to actually pick up on true orders in the market. So for example, this is the highest peak we have our money out, and then we have our money in. Price comes back down to that level, and we see a reaction and ultimately a bigger push off of that. So it's very, very simple to use the volume. Volume really doesn't take any understanding, but it's all about the context, guys. So that was the basic add-ons that you can put on to your Keep It Simple understanding a money in, money out concept. Remember, if you are using this concept, to backtest it and of course share your work with everybody in the Discord. If you have enjoyed this video, hit that like button and of course subscribe if you're not already a subscriber. And I'll see you all in Monday's live stream, and I hope you all enjoy your weekend. See you in the next one, guys. Peace out.